and everyone who signed up will get a copy of that. So with that, I'm going to introduce Jason Blair, the Executive Managing Director with R&T. So welcome, Jason.
Yeah, thanks, Teresa. I appreciate it. I see a number of familiar faces here on the webinar today, so appreciate you joining. I thought it might be helpful to provide a little bit of background on R&T for those who may not be as familiar with us. Get in the program here. Oops. All right. So who's R&T Solutions, Deposit Solutions, for those who may not know? R&T is a market leader in federally insured cash sweep programs, including both the NCUA and FDIC. We provide cash management solutions to credit unions, banks, trust and investment companies, as well as broker-dealers and other private and public entities. R&T's relationship-driven service model allows us to deliver customized deposit, liquidity, and cash management solutions to our clients. R&T offers strategic on and off balance sheet solutions. So what does that mean? We basically provide liquidity management programs to take credit union members' funds off balance sheet, so if you're in liquid circumstances. And then likewise for credit unions that are low income designated, who can obtain up to 50% non-member deposits, we can provide those with additional non-member deposits. We are a thought leader and educator on regulatory matters for our clients. And finally, we are an industry-leading firm established in 1974 that provides expertise in asset management, capital markets, and distribution to our clients. From a numbers perspective, here's a few just to help illustrate who we are. We've been in service, as I mentioned, since 1974, so over 45 years servicing the investment needs of our financial intermediaries. We currently have over 118 billion in assets under management. We have over 600 different institutions that we work with on a day-to-day basis. And finally, we currently administer over $7 million accounts under administration. So with further ado, I'd like to introduce a gentleman many of you know, Mr. Dennis Dollar, who's an expert on the credit union space. Dennis is a principal partner at Dollar Associates in Birmingham, Alabama. He was a former two-term member of the Mississippi House of Representatives. He served as president and CEO of former Gulfport VA Federal Credit Union. Mr. Dollar was appointed by, Mr. Dollar was appointed by President Clinton to the board of the NCUA, where he served from 1997 to 2004. In 2001, he was named chairman of the NCUA under President George W. Bush. During his time as chairman, he brought on RegPlex, Access Across America, Accountability and Management, and other services to assist credit unions. He started Dollar Associates, which is a leading consultant within the credit union space, shortly after departing from the NCUA. He has many recognitions, including the Mississippi Credit Union Hall of Fame, the Q's Hall of Fame, and he also received the Ambassador Award from the World Council of Credit Unions as a nationally recognized speaker and columnist in the credit union arena. Mr. Dollar, the show is yours.
Well, Jason, thank you very much, and thank you for the invitation from R&T to be a part of this webinar today. Dollar Associates sponsored a webinar on deposit management last year, and we needed an expert to come in and talk about some of the possible solutions that credit unions could have with all of this excess deposit that we're facing right now. And so I asked the folks at R&T if they would be a guest presenter on my webinar, and they did. And this is them returning the favor, I guess you could speak, or following up and saying, would you come now and be a presenter for us on this particular webinar? Because in my presentations to credit union groups over the last several months, I have specifically addressed the deposit challenge with somewhat of a different viewpoint, I guess, than what some others have. And that's what I want to talk about a little bit today with you. I know the credit unions who are on this and who've registered, many of them are our clients at Dollar Associates. Others of you have heard me speak before or are aware of my background. But I happen to be one of those who believe that the deposits that have flowed into our credit unions, and they flowed into banks and other financial institutions as well over the last 2 years, But from 2020 and 2021, there has been a predominant belief that these were fleeting dollars. In other words, they were dollars that were going to come in for a short period of time and then they were going to go out, that they were driven by the stimulus and that people would use that stimulus money. And it'd be somewhat like after a hurricane or a tornado, you have just millions and millions of dollars of insurance payments that come into the accounts while the people are waiting to hire a contractor to be able to fix their home. And then as soon as they get the contractor, they use the money that they put into savings to pay the contractor, and the money flies out about as fast as it came in. I have been somewhat of a contrarian on that, and I personally believe that most of these deposits that you have received in your credit unions over the last 18 months to 2 years are going to largely stay. And you are going to have to find a way to manage them, even though it is impacting your ratios. And I'm going to show you why in this presentation today. And I know the folks at R&T are going to then come back afterwards and at least address one of the things that you might consider. And I think it's certainly worth staying and hearing them out. Because you, in my opinion, you are going to have to address it and deal with it in some way much more long term than perhaps you have been thinking. So let me go into the reasons why. You may choose to agree with me. You may choose to disagree with me. You can send me an email. You can send me a chat question in the sidebar here of whether you agree or disagree. But let me tell you why I believe that this excess deposits that we have right now is something we're going to be dealing with for quite some time. First of all, credit union deposit growth has increased incredibly over the last 2 years. For the largest credit unions, over 44% deposit growth since 2020. For the more moderate sized credit unions, it's been about 26%. That compares to the 2 years before. So that's the 2 years of 2020 and 21. The 2 years before, in 2018 to 2019, it was 16% at the largest credit unions. Remember, the last 2 years, it's been 44. It was 9% for the more moderate sized credit unions, and it was 26% in the last 2 years. Now, what does that result in? Well, you know what it results in. It results in a lower load to share ratio, because you have, again, more shares, more deposits than you can loan out. It's a lower return on assets because, again, the assets are driven up by the deposits. So a lot of credit unions went in with a 10.7% cap, or maybe a 1% ROA, and ended up with a 70 basis point ROA. Net worth ratio is the other. A lot of credit unions went in with a 12% net worth ratio. That's their reserves versus their total assets. That now has dropped down to 9.9. Not because you have less capital, you're still growing capital, but the denominator, the assets has been inflated so much by the deposits. So it's really been at a time also where it's quite challenging for credit unions to keep up with this excess liquidity through your lending programs. I mean, new auto lending is down industry-wide and has been since even before the pandemic. In 2019, the auto lending was going down industry-wide. It had begun going down in 2017 and 2018, but it is markedly down. So that auto lending is one of the ways that we have always gotten rid of excess deposits. We've loaned it back to our members. Well, our members are not buying as many new cars. They're buying more used cars, or they're nursing along the cars that they have. The dealers don't even have the cars on the stock or in the lot to be able to meet what need is out there. So auto lending is going down, and the captive auto lenders, Honda Motor Credit and Toyota Motor Credit and Ford Motor Credit and GM Motor Credit, they're all giving all kinds of deals to try to sell what few cars that they have. So auto lending is down. Mortgage refinancing has pretty much peaked. The Federal Reserve is talking now about increased interest rates, which of course will result in fewer mortgage refinances. the new purchases are still doing well in the mortgage arena, but the supply is very limited. So therefore, the prices are going up, which is knocking more people out of the purchasing of a new home. So mortgage refinance and mortgage financing is in a somewhat of a downward, or at least a leveling off period. And then we've been sitting here again with that uncertainty as to whether or not this liquidity is going to stay or leave. NCUA and the state regulators have for 2 years been issuing letters to credit unions and making public statements that their belief is that the liquidity is transitory and that they're going to give time for those deposits to leave before they start coming down on the credit unions whose ratios are down. They're not going to hit you as hard on your ROA or on your net worth ratio, according to their statements the last 2 years, because they believe that these deposits are going to depart and that your ratios will return to what they were. And that's always a possibility that could happen. And I think most observers have believed that was going to happen. But if you look at where we are at the end of 2021, it hasn't happened yet. The deposits are staying and are even growing. And if indeed, again, I could be wrong, and NCUA and the state regulators could be right, and those who've been saying these dollars are going to eventually go away, well, when is eventually? Is it a year from now, 2 years from now, 10 years from now? But let's say I'm right, and most of them are going to stay. Let's look at some numbers and just see what the impact that will be on your ratios and the challenge that it will bring to you, to where that hopefully as a result of this webinar, you will go back and have meetings with your executive team or even discussions with your board in which you say, well, a lot of people think these dollars are leaving. They haven't left yet. And I just sat in on a webinar the other day where Dennis Dollar said that he believes that most of them are going to stay. And just in case Dollar's right, how are we going to look at and manage that? So I want to look at some numbers real quick. I want to show you, I want to take you back to 2018 so that we can do this comparison to see where we were. This is the summary of trends report that NCUA puts out at the end of every quarter, but I like the end of year numbers because you don't have to round them off. You don't have to annualize them. And it takes every credit union in the country and shows their numbers based upon their asset size, under 10 million, 10 to 100 million, 100 to 500 million, and then over 500 million. And you're going to see that they changed those categories a little bit over the course of time. But what's interesting here is that before COVID, before the deposit influx, here's what the normal share growth was. Look down there at that green line. For the over 500 million group, it was about 6.6% in 2018. And for the 100 to 500 million, the moderate sized credit unions, it was about 3.5. For the smaller credit unions, it was almost break even. And that's because most of them are not the primary financial institution of someone. They are kind of specialty types of credit unions, much smaller in nature. But those that are above 100 million, most of them are competing to be the primary financial institution, which is where excess deposits will go. So what was the loan share ratio in yellow there in 2018? Well, it was 88% for the over 500 million and 79% for the next group. What was ROA in blue? It was at 1% and it was at 68%. And the net worth ratios were both over 11. But let's look at 2019. Again, before COVID, it was a good year for deposits. You see the share growth there was 9.8% and 5.45, but still within the range of what it historically had been. And so therefore, loan to share ratios were 86 and 78. ROA was 1% and 74. It was pretty consistent with 2018. The total asset ratio, net worth ratio, 11.2, both over 11. Now let's look and see what happens in the first year of COVID in 2020. Here's the 2020 numbers. Now let's go down to the bottom and look at the green and see the share growth in 2020 was 26% for the larger credit unions and 16% for the more moderate sized growth credit unions. And again, going on down from there. So what did that do to the loan to share ratio? Look at what the loan to share ratio was at the end of 2020. It's now 75% and about 75% for both. The ROA that had been being a 1% is now 78 basis points and 61 basis points. The net worth ratio that was over 11 is now just barely over 10. What is the difference? Is the amount of capital that they built gone down? No. What has changed is the denominator. Those additional deposits have lowered the ratios that much. Now, this is when credit unions began to get concerned. What's NCUA going to say when they come in and my ratios are down? And that's when NCUA came out and said, we think these dollars are transitory. They're going to be leaving. And so therefore, we're not going to overreact to the fact that your ratios have gone down. We think that those dollars will be gone in the next 9 to 12 months, perhaps 18 months at the longest. Well, here we are now in the end of third quarter 2021. The end of year numbers are not out. So I can't give you end of year 2021. It should be another month or so before they are out from the most recent call report data. But look what happened in the first 9 months of 2021. The share growth is still up 18% and 10%. The loan to share ratio is now gone down into the lower 70s. The ROA still is holding in pretty well, but the net worth ratio has gone down even closer to 10%. So what you have had is a dramatic impact upon your ratios, the very ratios upon which NCUA and your state regulators give you your CAMEL ratings, the very ratios upon which they judge how safe and sound and strong you are as a credit union, the very ratios that they use to determine whether or not you are well managing your credit unions are all going down, largely driven by that share growth. So let's then examine this question. Why hasn't that money flowed out like we thought that it would? Yes, the rate of deposit growth did drop from 2020 to 2021, but it is still, as you saw, way above the historical average. I mean, in 2020, the deposit growth was 22% and 18%. It was 18 and 10% in 2021, but the historical average is 6% and 3%. Again, the first number is the larger credit unions. The second number is the more moderate sized credit unions. So we are still double, or even in this case, triple the historical average for share growth. Now let's kind of look at where that came from. There was $850 billion in direct stimulus dollars that was sent out to the American people during COVID to individuals and households. That is an average of $6,750 per household. It went out in stimulus payments. It went out in the child tax credit. $850 billion went directly to the American people, an average of $6,750 per household. Now, stay with me just for a minute. There were caps on income in that program that said if you make over a certain amount of income, you don't get it. But the amount was fairly high. It was about $175,000. And there are all retirees whose income is less than that, but many of them have savings that they have made over the course of their lifetimes and have built their nest egg. They still got the stimulus dollars, as did a number of people who had good jobs, had businesses, didn't lose them during COVID. Actually, some had an upturn in business during COVID. They still got the stimulus dollars. It was not need-based. It was not based on need. It had a cap on it as far as income level, but it wasn't need-based. So therefore, you have to assume that some of the people who got the COVID money, the stimulus dollars, the child tax credit, had not got laid off from their jobs. They had not faced additional expenses. And in fact, because of the moratorium on evictions and the moratorium on foreclosures, many of these folks at the same time were not having to make their mortgage payment or not having to make their rent payments. So the ability to have that additional dollars for someone who really didn't need it, put that money to something that they had to use it for otherwise. And we'll show you in just a minute what the statistics show they use it for. But the unemployment peaked at 14.8% in April of 2020. That's when it peaked. That's when most of these dollars went out. They went out during that period of time that it assumed that many people were losing their job because their business was shut down, their restaurant was closed, they weren't able to they weren't able to maintain employment. But that went down to 10.2% by July and 6.7% by December. So the unemployment rate's going down. The need for the money was going down, but the dollars were still coming. And they continued on through 2021. By the end of December 2021, unemployment is down to 3.9%, but the stimulus dollars from the child tax credit were continuing to come about every quarter during 2021. I'm not criticizing the government for doing that, although there are those who have. I'm just saying that because it wasn't need-based, the result is a lot of folks got those stimulus dollars, and a lot of folks got those child tax credit dollars that did not need it to survive. They did not need it to pay their bills. They did not need it to pay their rent or their mortgage. So therefore, they were looking for something to do with it. Well, here's what the estimates show, and this is my site here is an article there that how households use their stimulus payments and how they would spend the next one, and you can click on that as a link there or copy it and read this article. But the estimates showed, and this was very interesting, that the recipients of stimulus dollars on average saved 36.4% of their stimulus. Another 34.5% used it to pay down debt. 29% of the stimulus, according to the studies, was used for essentials. Those are the folks who really needed it. Those are the folks who had to have it to be able to continue to pay their light bill and their water bill. They're the ones who used it to be able to pay their rent or to be able to get gas in the car. But think about that. Of those billions and billions of dollars that went out in stimulus, 29% was used for essential, and you have got now over right at 70%, over 70% of it that is used to either pay down debt or to be put into savings. Now, that's a dual hit for financial institutions such as credit unions. Our deposits go up and our credit card balances go down because that's where most of the debt was in credit card. So they paid down our credit cards. We're not making as much on the credit card. And the remainder of it was put into the savings account, usually into an account that was held by the primary financial institution, which credit unions battled to be. But let's kind of look at the deposit side of the ledger as it relates to the dollars from the stimulus that went into savings. If indeed 34.5% went into savings on, and that's the number for paying down debt, so it's actually a little bit more, went into savings on $850 billion in stimulus, the total just from stimulus into deposit accounts was $309.4 billion nationwide. So $309 billion went into savings. This increased savings, because of its amount being in smaller segments and spread out over the years, went primarily into liquid accounts at the credit union. It went into either a money market account or a checking account, something like that, maybe a basic savings account, but they didn't put it in a CD. They didn't put it into their IRA because they came in smaller segments. It was $1,000 here, $1,200 here, $750 there. It added up, but it didn't come all at one time. If so, they might would have put it in a CD. But the savings was placed largely into those financial institutions that were the primary financial institutions, where they had their savings account, where they probably had a money market account, probably where they had their checking account. So in answer to the question, is deposit growth slowing? Yes, we have seen that it has slowed, but it slowed from 26% down to 18%. Are the excess deposits leaving? Well, the numbers are showing that they are not. or if they are, they're slowing too slowly to count on you being able to return to your previous ratios in 2022 or maybe even 2023. So let's get back to the credit union challenge then. If I am right, and it does appear that these deposits are going to be here longer than we thought they were going to be here, how long will it be until the regulators and the examiners come to that same conclusion? And they begin looking at ratios as if the deposits are not transitory. All of a sudden now, your examinations are going to be more challenging. They're going to be more difficult. It's going to be harder for you to invest in some of the things that you need to invest in, perhaps whether it be technology or new branches or new products and services, because your ratios are down. And now the examiners are writing you up for the ratios being down. Again, NCUA and the regulators have been very reasonable, and I give them great credit for the fact that they have been reasonable, and they have looked at these ratios as if the deposits are transitory. But I can tell you, as a former regulator, as a former NCUA chairman, that will not last forever. And if they come to the conclusion that it looks like these deposits are going to be here long term, now they're going to start looking at your ratios and say, okay, how are you managing it? How are you using that at your credit union? How are you ensuring your safety and soundness now that long term you have more dollars at risk because there are more assets and more deposits in the credit union? And I think you're all aware that the new risk-based capital regulation is being implemented this year, January of 2022, for the first time for all credit unions above 500 million in assets. If you were under 500 million in assets, you did not have to follow the risk-based capital standards that are in that rule. In addition to your net worth ratio, you had to have a risk-based capital ratio. If you were under 500 million, you just had to worry about the regular net worth ratio. The risk-based capital did not apply. But what if you were sitting at 420 million until the deposits came in? Now you're over 500 million. Now you're under RBC. You're going to have a harder exam. You're going to have more statistics that you're going to have to run. You're going to have more comparisons that you're going to have to do. You're going to have more of your assets that are categorized as more risky or less risky, all because of the influx of deposits that you have. So how many credit unions are going to be driven over 500 million and therefore become subject to risk-based capital as a result of these increased deposits? Well, the number is actually in the vicinity of 500 or 600 that are going to be driven over 500 million as a result of the deposits of 2020 and 2021. You've got another factor too. NCUA has a special examination program for credit unions that are over $1 billion in assets. The examinations are longer, they're more extensive, they're bigger teams. Again, you can manage it, but if you were at 900 million or 840 million, and now as a result of these deposits, you're over $1 billion, well, there's one side of you that celebrates the fact that I've gone over $1 billion in assets, but there's got to be another side of me that says there's additional examination scrutiny that comes. There's additional stress testing I have to do. There's additional questions that I'll be asked at my exam because I'm over $1 billion in assets. Well, really, I'm an $840 million credit union that just happens to have $240 million in excess deposits that has made me $1.2 billion. And here's an even bigger one. How many credit unions will be over $10 billion in assets because of the increased deposits? And thus, when you go over $10 billion in assets, you now become subject to the CFPB, the Consumer Financial Protection Bureau's direct oversight, where they can come in and do an examination of your credit union and will. Plus, you trigger the debit interchange revenue reduction through the Durbin Amendment, whereas right now the average credit union under $10 billion in assets gets 43 cents every time a member swipes their debit card. Once you go over 10 billion in assets, under the Durbin Amendment, you start getting an average of about 23 cents. I have clients that have said the difference between being 9.9 billion and 10.1 billion to me is $27 million a year just in the debit swipe fee difference. Well, most credit unions, as they near 10 billion, realize it's coming and they plan for it. But over 2020 and 2021, all of a sudden they've had an extra $1.5 billion of deposits that have come in. And the bigger the credit union, the more the deposits have come in. And so now they are over $10 billion in assets, dealing with the CFPB, dealing with debit interchange revenue reductions because of the fact that these deposits have not been as transitory as perhaps we thought they were going to be at the beginning. So that brings us to really the question. Again, I could be wrong, and over the next 6 to 9 months of 2022, we should see most of those dollars flowing out. And if so, I will be more than glad to admit that I'm wrong, and I'll come back at some future webinar and say, I was wrong about that. It needed a couple of years to work through the system, and now by June 30th of 2022, it's all gone. But frankly, my friend, having been an observer of credit unions since 1992, when I went to work for the first time at my credit union, through my years at NCUA on the board, through my years as chairman, and now through 18 years of working as a credit union consultant, I will tell you that our take here at Dollar Associates is that these dollars are here long term. These deposits are going to stay. Yes, it will decrease unless there's an extension of the child tax credit. If so, then it could go for another year. Or if the Omicron variant forces Congress to go back and do another stimulus, well, then you could have it extend for another couple of years. But that most of the dollars who came, we're figuring at least 80% of the dollars that came into you during 2020 and 2021 are going to be with you for at least 3 to 5 years. So if that is the case, in case I'm right, what do we need to do? Well, I've never been one as a good consultant to give you a challenge without at least speaking to some of the things that you can consider, and these are just some things to consider. First and foremost, you need to start looking at your credit union's balance sheet as if those excess deposits are long-term and not short-term. You need to say, okay, I've been thinking they'd be gone by now. They're not. I've got to start looking at that balance sheet difference. You can use this time of excess liquidity to consider some more costly investments that would have a longer-term payback, sometimes technology, sometimes branching, that the credit union might be hesitant to take when the liquidity is tighter and the liquidity is shorter term in duration. You don't want to hit the liquidity for that technology investment or for that branching investment. This is a time of excess liquidity, and you're not getting much on it at the local corporate, or you're not getting much on it, or where you're investing it in short-term investments. So therefore, it's perhaps a time to look at perhaps spending some of that you've been looking to spend, that you think you need to spend to remain competitive, but you were afraid of the liquidity. Now it's also a good time to look into areas of lending that you might have delayed considering, such as, aqua lending, boat lending, RV lending, solar lending, manufactured housing lending, or some of you maybe even who have not done indirect lending in autos or even business lending. And you said, I want to wait for the right time on that. This may be the right time because you've got these dollars that need to be loaned out. You're not drawing anything on them in your short term or your overnight accounts. So it may be an area to look at expanding your lending programs, or perhaps that next bullet there, going a little deeper in the loan pool based upon your risk tolerance. If your delinquency is sitting there at 0.2 or 0.3, 0.4, maybe you can look at going a little deeper into the loan pool to be able to make more loans, taking a little bit more credit risk, moving a little bit beyond just the A paper or the B paper, and moving a little bit more perhaps in a managed way with a good underwriting, with a good follow-up collections, to go a little deeper in the loan pool. You may not want to go into other areas of lending, but you might could go deeper in the loan pool in the areas that you are now lending. Another option is to look now at QSO investment, either on your own or work with other credit unions to invest in credit union service organizations that can help you generate non-interest income, or can save you dollars, or can help you with your risk mitigation by sharing risk with other credit unions. It takes a few dollars to invest in a QSO, to start a new business that's owned in whole or in part by your credit union. You now have the dollars in that excess liquidity. You're not earning much on them, if anything, in your overnight accounts. take some of that and invest it in a good QSO opportunity that has the potential to get 6, 7, 8, 10% return for you versus the virtual no return that you're getting that you would not have been able to do if you were loaned out to 98%. But now that you're only loaned out to 81% because of these additional deposits, to consider doing that. And then the last one, which is a part of the reason that R&T is sponsoring this webinar, is that there are programs out there. Theirs is a good one, and I will tell you, I've got clients that use their program, know the folks well, have done some regulatory work for them in the past. That they are a top-notch firm. They've helped a couple of my clients to really deal with some of these balance sheet issues. But whether it's them or whether it's someone else, there are programs out there that can help you take some of your deposits off balance sheet through deposit management programs, kind of a sweep type programs in which for example, if you have a member that has $600,000 in deposit at your credit union, well, they've got more than what the insurance covers. The insurance covers $250,000, or if it's a joint account, covers $500,000. So they've got exposure out there of uninsured deposits. And if you could find a sweep program that would enable those dollars to be swept into another institution, another credit union, maybe even a bank that is federally insured with either NCUA or FDIC insurance, you can do the member a favor by being able to provide that sweep program and be able to enable them to get the more expanded insurance coverage. You can do yourself a favor by getting that extra 100,000 or that extra 200,000 off of your balance sheet and into someone else's. And if you have the right program, you have it structured in a way to where whenever you need it back, all you've got to do is ask for it. The other credit union comes, they provide it back to you, and you're able to meet the members' needs when they need it. These types of programs, the R&T program, others that may be out there, even possibly you could go and make arrangements with fellow credit unions yourselves to be able to have deposit participations like you have loan participations. But it's something that's probably timely to consider. If you're getting close, for example, to getting to that $500 million in assets and you don't want to go over until you're ready, or you're getting close to $1 billion and you don't want to go over till you're ready, or if you're getting close to $10 billion and you don't want to face the CFPB until you're ready, and you don't want to give up that interchange revenue until you're ready, if you could take, a few 100,000, even a few 100 million, or maybe even $1 billion off of your balance sheet into these sweep type programs, you could at least buy the time to be able to prepare yourself budgetarily and in your strategic plans for going over those thresholds without just finding out one day I'm over the threshold. And that's happened to a lot of credit unions. It's happened to a lot of my clients over the course of the last 2 years. And again, if all those deposits flow out over the next 6 months, well, then it's not as big of an issue. But if they don't, and I think I've shown you some numbers that should be somewhat at least challenging for you to think about the possibility that they will not, then you need to look at ways to be able to maximize that, to plan for it, to strategically be able to approach it. So with that, I'm going to kind of end my remarks here, turn it back over to the R&T folks to be able to share a little bit about their program, and then we're going to take some questions at the end. You can ask them a question, or you can ask me. I'm going to stick around. And feel free to challenge me if you want to. You think that in your credit union these deposits are leaving, and that you think that they will be gone by the end of June of next year. If so, then perhaps my assessments are not universal. But among the credit unions, and we work with over 700 credit unions in some capacity. We have more than 100 that we work with on an ongoing engagement basis. There have been very, very few. I think I can name only one or two that have actually said, I think the dollars are leaving short term. Most of them have said, I never thought they'd stay this long. I never thought it would continue to grow. And I've got to figure out now how to manage it. So therefore, with that, that's the end of my remarks. Let me turn it back to Jason, and then we'll take your questions at the end.
Yeah, thanks, Dennis. That was extremely informative. And we haven't talked about this, but as you were going through your remarks there, right, as I look at the stock market, it seems overpurchased. I think it has been for quite some time. I expect some type of pullback, but historically in the midterm elections, which obviously we're in this year, historically it's a 17% pullback in the marketplace and the equity market place. And once they do that, obviously they pull out of the equity market. They have to have somewhere to go, and they obviously are going to probably go to credit unions and banks and make them even more liquid. So I agree with the majority of your remarks. We'll jump in real quick. And by the way, this isn't a sales pitch. We are a relationship institution. I think Dennis can vouch for us on that. But this is really just educational, just to really walk through what we can do for some of your deposits. That if you are liquid, how can we help you? So really, it's DDM send, demand deposit marketplace send for credit unions. It really acts just like a off-balance sheet money market. But the DDM program allows credit unions to move excess member deposits off balance sheet. So we can move those either into NCUA insured institutions or FDIC insured institutions, or quite frankly, a combination of both. So these deposits can remain off balance sheet, as Dennis mentioned, until you become, until you need core funding again or any type of funding. At that time, our program is daily liquidity. You can bring those funds back on balance sheet once your loan and investment growth start to increase. So some of the benefits here we notated for benefits for credit unions themselves. Obviously, send excess deposits off balance sheet. Enables you to shrink your balance sheet if you need to. It provides a way to generate fee income. So we do actually pay for these deposits. The majority of the folks that we're working with on the credit union side care more about their member maybe than the banks do, and they want to pass that whole amount onto their members. But the real reason is because all of a sudden now you can gain more of the client's wallet share, right? You offer a new product instead of offering $250,000 singularly or $500,000 jointly. Now you can offer a $30 million FDIC insured program, so you can gain more of that client's wallet share. Moving on here, some of the benefits here for the members, obviously access to multi-million dollars in federally insured deposits. As I mentioned, it provides same-day liquidity. We have a highly competitive rate. The rate that we provide you is your rate. It's the credit union rate. You can set whatever rate you want for your members. So if you want to set it at 5 basis points, or if you want to set it at 50 basis points, we don't care. You own that relationship. We want you to continue to own that relationship. They're your members, not our members. We want to sit in the background. You have a single point of contact through your own credit union. So it doesn't matter if you place $1 million with us. For your member, it goes out to 4 different credit unions. Those other credit unions aren't going to know your member. You're the single point of contact. You come to us, and we contain all that information, or maintain all that information. Also, we have Deposit View, which is an online portal to view accounts 24/7 for not only the credit union yourself, but also your members. I'm not moving forward here. So Teresa or Melissa, if you could help me out.
Oh, yeah.
There we go. Yep. Sorry about that. Yeah, so how does it work? Again, these are really, it acts and looks just like an off-balance sheet money market fund. So in this example, it's your client has $1 million. Your member has $1 million. You send it in to your credit union. Your credit union then sends it into us. For that $1 million, we're really going to send that out to banks and or credit unions, so whichever you prefer. We're going to break it into $250,000 increments, making sure that all the principal and interest is all insured. Again, we've already talked about the rate there, but when you send funds off balance sheet, they maintain off balance sheet until you need them back on balance sheet. Once you do need them back on balance sheet, again, there's daily liquidity. So whether the credit union needs those funds back or the credit union member needs those funds back, we do offer daily liquidity for all of our products. So here's a couple quick case studies here. So the first one, Dennis mentioned, I won't call it a $10 billion credit union. They were a $10 billion credit union when they called us. They are no longer a $10 billion credit union. They're about 9.5 to 9.9 on any given day. But the goal here was to stay under that $10 billion mark. As Dennis mentioned, the credit union loses just about half of their interchange income whenever they go over the $10 billion mark. They're regulated by the CFPB, which is additional regulatory oversight. And as Dennis mentioned, from the institutions we talk to from the credit union standpoint, they tend to lose anywhere from $20 to $30 million per year, just with the regulatory oversight and losing half of their interchange income. So the strategy here was obviously to bring deposits off balance sheet for that $10 billion credit union. Our program does up to $30 million of FDIC NCUA insurance. This credit union in particular said, hey, look, let's start small. Let's offer $1.5 million of NCUA FDIC insurance. We'll send that out to 6 to 8 different credit unions and banks. So we started very small. It grew pretty rapidly. And the result of this is that we're now sweeping $3 billion from this credit union off balance sheet for them. So really not a $10 billion credit union. They're a $13 billion credit union. So and when this credit union does want to go back, sweep these funds back on balance sheet, instead of going from 9.9 to 10.1, where it's going to cost you again $20 to $30 million every year, this credit union has decided, hey, we're going to wait till we're 15 or 16 or maybe even 17 billion, and then make the large jump. But the big thing here is you're capturing more of the members' wallet share. So offering a new product out there, as we mentioned before, with extended federal insurance. Second thing is you're able to bring in new deposits and new members. So they marketed this out to their current members as well as potentially new members out in the community. And they, again, as I mentioned before, they're able to jump from 9.5 to maybe 15 or 16 or 17 in the near future. Moving on to the next case study here. Again, this really gets into what we normally do. This is a $900 million credit union. They just want to be able to provide peace of mind to a certain amount of their members that have over $250,000 in single or $500,000 in joint NCUA insurance. So again, they offered our program out there. Way to gain access to $30 million FDIC insurance. And currently we're sweeping about $140 million in member deposits off balance sheet that's maintained through the DDM program. And final slide here. These are some of the products that we offer, right? So we already talked really about the top left corner, which is send only, enables you to shrink your balance sheet, mitigate carrying costs, generate fee income, and provide your clients with millions of dollars of federally insured deposits. The second one is really on the second left tier there at the bottom. That's receive only. This is primarily for your low-income designated credit unions that can take up to 50% of non-member deposits on balance sheets. So we do have the ability to do that, and we are working with many credit unions right now on that. We also have a reciprocal program, a DDM reciprocal. Again, it's the same exact thing as what your send only is, except for whenever you send funds in, you get that exact same member or exact same dollar amount back on balance sheet. So it's really a dollar for dollar matching program that you can send into our program all the way up to $30 million of FDIC insurance. We can send those funds back as well. And really that concludes what we had to present. Teresa, Melissa, I'm gonna turn it back over to you all. Maybe I think we have 8 minutes left here for some Q&A.
Yeah. Thank you very much, Dennis and Jason. I think Melissa had a couple questions come through on the chat. Do you want to bring those up, Melissa? I'm not sure if she's on mute, but I can go ahead and grab a couple of these.
Sorry, no, I have it. I'm sorry.
Okay, no problem.
Should credit unions consider going into the secondary market to buy loan pools?
Dennis, I'm going to let you take that one. I think it was, can credit unions go into the secondary market to buy loan pools?
Yes, they can, and they can also go into where the kicker comes there. They can only hold a loan of their members. So what makes it difficult going into the secondary market and doing an entire pool is within that pool of loans, there may be some that are their members and some that are not. And so they are only able to hold those of their members unless those were generated originally from another credit union where the person was a member. So most credit unions, rather than going into the secondary market to buy loan pools, will go to a credit union that is very heavily loaned out and will do a loan participation, or what is called a loan participation, which is basically buying a pool of loans from that other credit union. And in that case, they don't have to be your members because they were members of the credit union that originally bought them. But if you buy them from a source outside of the credit union, you're going to have to either determine that those are members, or you're going to have to memberize them, if you will, once the loan comes to you. And that becomes somewhat of a cumbersome process. So the answer is yes, you can do it, but the field of membership factor does come into play. We do a lot of field of membership work in our firm, and we do it for a lot of different reasons, all of which are growth oriented, of course. But one of the reasons that we get a lot of credit union clients needing help on field of membership is that as they buy loans from other sources, they need to be able to find ways to make them members of their credit union. And you've got to have the field of membership that authorizes that. So that's a little bit of a long answer to the question, but the answer is yes. Membership comes into play.
No problem. We have another one?
And yes, I do. Can you talk more about the pricing cost to the credit union, a cost per unit or something along those lines?
Sure. Yeah. So there's absolutely zero cost for a credit union to join DDM. Especially whenever you're sending funds off balance sheet. So when you send funds off balance sheet, we actually pay you for your deposits. So whether they're credit union deposits, your own credit union deposits, or they're your credit union member deposits, we actually pay you for those. In normal times, we're not in normal times. We're pretty liquid right now, as Dennis mentioned, but we really hover around that Fed funds effective rate. Normally plus a few basis points. So. But there is no cost whenever you're looking to place funds with us. For low income designated credit unions that are actually looking for deposits, we can set up a relationship with institutions that come to us directly. We're not a credit union, we're not a bank, we're not federally insured. We can't take those deposits on balance sheet. However, if you are looking for those types of deposits, those member deposits, we're more than happy to give introductions into trust companies, municipalities, and those institutions alike.
Great, thank you. Melissa, is there any more? We have time for maybe one more.
One more? Okay. Can a credit union pay a higher rate to our member than what R&T is offering?
Yeah, absolutely. So, for example, if we're offering 5 basis points for your credit union member funds, to take those funds off balance sheet, again, in a normal world, it would hover around that Fed funds effective plus range. But obviously, in this liquid market, we're down to about 5 basis points that we're paying. So if you wanted to pay your credit union member, and we do have this right now, where the credit union member they care about their member, obviously, and so they're paying them 25 basis points. Let's say you would just make up that spread differential of 20 basis points. We'll provide that 5. You pay the 20. Your member's getting 25.
Okay. Melissa, was there a short one? Was there one more question out there really quickly?
Yes. How much fee income could we get on $80 million?
So there's a specific question for you, Jason.
Yeah.
I got my calculator on. Hold on.
Just let me know if you want to follow up with that separately. We can mark it.
Yeah. So I mean, on an annualized basis, you're probably looking around $35,000 to $40,000. But again, you have to think about what you're paying your member, right? So if you're paying your member 10 right now, and we're offering 5, then you're gonna have to make up that spread differential. But you would still save 5 basis points. So 5 basis points at $80 million is $40,000.